Bitcoin is trading at $69,000. That sentence would have been received as delusional fantasy in 2020. It would have been dismissed as optimistic speculation in 2022, when Bitcoin was trading at $16,000 and every headline in the financial press was explaining, with great confidence, why the entire asset class was finished. It would have been considered reasonable in January of 2026, when Bitcoin touched $97,000, and institutional investors who had spent years calling it a tulip bubble were quietly filing ETF allocation requests with their compliance departments. And today, at $69,000, after a correction that has lasted approximately 8 weeks, the same financial press that missed the run to $97,000 is now explaining, with equal confidence, why $100,000 is unreachable in 2026. They were wrong about $16,000. They were wrong about $30,000. They were wrong about $60,000. The question worth asking is not whether they are wrong again. The question worth asking is why they keep being wrong and what the structural forces are that keep producing the same analytical failure at every price level Bitcoin has ever visited. The answer to that question is what this video is actually about, not price predictions, not number go up, not the kind of breathless speculation that passes for analysis in most crypto content on this platform. What this video is about is the 5 structural forces that are currently aligned simultaneously for the first time in Bitcoin's history in a configuration that makes $100,000 not just possible, but analytically defensible based on sources that include JP Morgan, Standard Chartered, Motley Fool, Changelly, Henrik Zayberg, and prediction markets that are currently pricing the probability at between 40 and 50%. 40 to 50% probability on a single asset movement within a 12-month window is not a long shot. In options markets, that is called at the money. That is the definition of genuinely possible. We are going to examine each of the 5 forces in detail, look at the data behind each one, and at the end, talk about how to prepare. Not with a generic advice that fills the last 30 seconds of every crypto video, but with the specific framework that the data actually supports. Let us begin. The most important thing that happened to Bitcoin in the last 2 years was not the halving. It was not the regulatory environment shifting. It was not any single price move or market event or macro development. It was the approval of spot Bitcoin ETFs in the United States in January of 2024, and the subsequent construction of an institutional acquisition machine that is still running at full capacity in March of 2026. Here are the numbers, because the numbers are the argument. As of March 10th, 2026, spot Bitcoin ETFs have accumulated lifetime net inflows exceeding $55 billion. $55 billion of institutional and retail capital that did not exist in Bitcoin's addressable market before January 2024. In a single week ending March 10th, Bitcoin ETFs recorded net inflows of $568 million. On March 10th alone, one trading day, inflows hit $251 million. Total weekly trading volume across Bitcoin ETFs reached $23.1 billion. These are not small numbers. These are not speculative retail flows from people watching YouTube videos about number go up. These are institutional flows, pension funds, endowments, registered investment advisors allocating client portfolios, family offices, corporate treasuries following the model that MicroStrategy established and that a dozen other corporations have since replicated. Henrik Zayberg, the macroeconomist whose forecasting record on this cycle has been notably precise, stated explicitly in early March of 2026 that Bitcoin rallies to $110,000 to $120,000 in his primary scenario, fueled by what he called risk-on fever, ETF inflows, and continued institutional adoption. He described $100,000 as well within reach, potentially as early as the second quarter of this year if risk appetite returns to markets. JP Morgan, which spent approximately 5 years dismissing Bitcoin as worthless before quietly becoming one of the largest processors of Bitcoin ETF transactions, has stated that if institutional inflows persist at current rates, Bitcoin reaching $100,000 before the end of 2026 is a realistic base case, not an optimistic case, a base case. Here is the mechanism that makes this mathematically coherent, rather than just optimistic. Bitcoin has a fixed supply, 21 million coins total, approximately 19.8 million already mined. Of those, an estimated 3 to 4 million are permanently lost, in wallets whose private keys no longer exist, on hard drives and landfills, in early mining operations where the coins were abandoned before they had any meaningful value. Exchange reserves, the Bitcoin sitting on trading platforms available for immediate sale, are at multi-year lows. When institutional ETF flows demand Bitcoin and exchange reserves are at multi-year lows, the price impact of each additional dollar of inflow is amplified. There is simply less Bitcoin available to absorb the buying pressure. The ETF machine is not slowing down. The ETF machine is accelerating. And every week it runs, the available float of Bitcoin contracts further while the institutional demand base expands. That is not speculation. That is arithmetic. Bitcoin has never existed in a macro environment quite like the one that exists in March of 2026. This statement requires explanation, because every Bitcoin cycle has been accompanied by claims that the macro environment is uniquely favorable. What makes this moment structurally different requires precision. 3 macro forces are operating simultaneously, and their combination has no historical precedent in Bitcoin's 15-year existence. Before we go any further, one thing needs to be said clearly and without ceremony. Nothing in this video is financial advice. The analysis here is based on publicly available data, institutional research, and documented market forces. But markets do not follow analysis, and Bitcoin has proven repeatedly that it can move violently in both directions with no warning. Do not invest money you cannot afford to lose entirely. Do not borrow to buy Bitcoin. Do not allocate rent, emergency funds, or any capital that has a specific obligation attached to it. The 1% to 5% portfolio allocation discussed later in this video exists precisely because even the strongest analytical case can be wrong, and position sizing is the only risk management tool that works before a loss happens rather than after. If that framework does not fit your financial situation, the right allocation is 0. There is no shame in that. Protect your financial stability first. Everything else is secondary. The first force is the global M2 money supply. The combined M2 of the major central banks, the Federal Reserve, the European Central Bank, the Bank of Japan, the People's Bank of China, has expanded by approximately 10% over the trailing 12 months. 10% expansion in the global monetary base means 10% more currency units chasing the same quantity of real assets. Bitcoin has a fixed supply. When the quantity of currency units increases and the supply of Bitcoin does not, the math of that relationship is not complicated. The Motley Fool, which is not a publication known for maximalist crypto advocacy, published an explicit price prediction in February of 2026, stating that Bitcoin will hit $100,000 in 2026, specifically because larger liquidity will enter the system as central banks maintain accommodative stances. That is not a crypto newsletter. That is a mainstream financial publication telling its readers that Bitcoin reaches $100,000 because of macroeconomic forces, not despite them. The second force is the interest rate trajectory. The Federal Reserve has been in an easing cycle. Interest rate cuts reduce the opportunity cost of holding non-yielding assets. When a 2-year treasury yields 5%, allocating capital to Bitcoin carries a significant opportunity cost. When that same treasury yields 3% or less, the opportunity cost calculation changes entirely. The risk-adjusted case for Bitcoin allocation improves at every rate cut, and the Federal Reserve has been cutting. The third force is the American fiscal situation, and it requires saying something that mainstream financial commentary is reluctant to say clearly. The United States government is adding approximately $2 trillion per year to its national debt. The total debt is approaching $37 trillion. The interest payments on that debt are now the largest single-line item in the federal budget, exceeding defense spending, exceeding Social Security, exceeding every discretionary program combined. A government in that position has a structural incentive to prefer inflation over deflation. Inflation reduces the real value of existing debt. It is the most politically painless form of fiscal adjustment available. Bitcoin was designed explicitly for this environment. 21 million coins, fixed. No central authority capable of deciding to print more. No committee that can vote to expand the supply in response to a fiscal emergency. The supply schedule is written in mathematics and enforced by a global network that has been running continuously since January 3rd, 2009. When the macro environment combines expanding money supply, falling interest rates, and structurally inflationary fiscal policy, simultaneously, Bitcoin's fixed supply proposition becomes not just theoretically interesting, but operationally relevant. That combination has never existed before in Bitcoin's history. It exists now. The Bitcoin halving of April 2024 is the most discussed and most misunderstood event in the current market cycle. The standard analysis goes like this. The halving reduced Bitcoin's daily new supply from 900 coins per day to 450 coins per day. Less new supply means upward price pressure. Bitcoin went up after previous halvings. Therefore, Bitcoin will go up after this halving. That analysis is not wrong. It is incomplete in a way that causes most analysts to underestimate the duration of the halving effect. Here is what the data from previous cycles actually shows, measured precisely. After the 2012 halving, Bitcoin's peak price appreciation occurred approximately 12 months after the event. After the 2016 halving, the peak occurred approximately 17 months after the event. After the 2020 halving, the peak occurred approximately 18 months after the event. The April 2024 halving is now approximately 11 months in the past, as of March 2026. If the historical pattern holds, And there are structural reasons to believe this cycle runs longer rather than shorter due to ETF inflows amplifying the supply shock. The peak of this cycle's price appreciation has not yet occurred. Changeli's technical model, updated in March of 2026, projects a maximum of $100,874 in 2026, with a monthly average in December approaching $101,000. That model is based explicitly on supply shock dynamics combined with historical post-halving cycle analysis. Before the halving, Bitcoin miners were producing approximately 900 new Bitcoin per day and selling a significant portion to cover operational costs. That selling pressure was constant, daily, and structural. After the halving, that production fell to 450 Bitcoin per day. Miners are selling less because they are producing less. The constant daily selling pressure has been cut in half. Against a backdrop of increasing institutional demand through ETFs, that reduction in sell-side pressure has a price impact that compounds over time rather than expressing itself in a single sudden movement. The halving effect and the ETF effect are not separate forces operating in parallel. They are interacting forces that amplify each other. The halving reduced new supply. The ETFs are absorbing available supply. The combination is a supply squeeze that the Bitcoin market has never experienced simultaneously with institutional-grade demand infrastructure. This is structurally new, and it is not done. The most underappreciated driver of Bitcoin's potential appreciation in 2026 is the regulatory environment, specifically because regulatory clarity does not produce immediate price effects. It produces structural effects that take 6 to 18 months to translate into capital flows. Those capital flows are now beginning to arrive. For the first decade of Bitcoin's institutional life, the single largest barrier to allocation by pension funds, university endowments, insurance companies, and registered investment advisors was not price volatility. It was regulatory uncertainty. Fiduciary duty requirements, the legal obligation of institutional money managers to act in the best interests of their beneficiaries, made it genuinely difficult to allocate to an asset class where the regulatory treatment was unclear. Could Bitcoin be classified as a security and subjected to retroactive SEC enforcement? Could custodians legally hold Bitcoin on behalf of institutional clients? Could a pension fund manager be held personally liable for a Bitcoin allocation that lost value? The answers were unclear, and in institutional money management, unclear means no. The Crypto Clarity Act and the broader regulatory framework developing under the current administration have begun resolving these questions, not perfectly, not completely, but sufficiently for compliance departments that were previously saying no to begin saying, let us discuss the parameters. That transition, from no to let us discuss, is where the next wave of capital originates. Before we get into exactly what this means for the global economy, I want to take a very quick pause. I want you to listen to something very important, because I have a specific message directly for you. If you are still watching this breakdown right now, you are officially in a very small and elite minority of people. The vast majority of the internet is completely distracted by short attention spans and meaningless entertainment today. The fact that you have made it this deep into such a complex strategic analysis proves you are entirely ahead of the curve. You possess the rare focus and discipline required to actually understand how the global board is moving before everyone else does. Right now, it is early evening on this Tuesday, March 10th, 2026. Wherever you are watching this strategic breakdown from today, I would love to know exactly who is in our community. Please drop a quick comment below with your city, your local time, and what the weather looks like outside your window. Reading your comments and seeing our global reach is genuinely one of my favorite parts of creating these deep dives. While you are leaving that comment, please take 1 second to hit that like button and subscribe to the channel. Your support tells the algorithm that you value serious research, and it helps engineered markets grow stronger every single day. I truly appreciate you being here and taking the time to engage with this level of research. Let me know where you're watching from, and let us get right back to the analysis. Multiple institutional analyses published in February and March of 2026 from Bernstein, Vanek, Markets.com, and multiple Motley Fool contributors identify regulatory clarity as the specific catalyst that could take Bitcoin not just to $100,000, but beyond. Vanek maintains a base case above $100,000 specifically because of this regulatory development. Bernstein cites regulatory clarity as the primary driver in their institutional allocation models. Here's the capital that has not yet arrived but is positioned to arrive. American pension funds manage approximately $40 trillion in assets. University endowments manage approximately $800 billion. Insurance company general accounts hold approximately $8 trillion. Sovereign wealth funds manage approximately $10 trillion globally. The vast majority of this capital has zero Bitcoin exposure because the regulatory framework previously made allocation either impossible or legally risky for fiduciaries. As that framework clarifies, even a 1% allocation from these pools represents $400 billion of potential Bitcoin demand. Against a Bitcoin market capitalization that currently sits at approximately $1.4 trillion, $400 billion of new institutional demand is not a marginal event. It is a structural repricing. This capital moves through committee approvals, board votes, compliance reviews, and manager selection processes that take 6 to 18 months from regulatory clarity to actual deployment. The regulatory clarity began arriving in late 2024. The deployment is arriving now. This is not money that shows up in a week and leaves in a month. This is strategic allocation money, the kind that creates a persistent demand floor and makes drawdowns shallower than previous cycles. The fact that Bitcoin corrected only 29% from its cycle high, while previous cycles produced corrections of 50 to 80%, is itself evidence that this institutional floor is already functioning. This is the reason that the other 4 reasons underestimate. The previous 4 forces operate within a framework where the existing global financial architecture continues to function as designed. The 5th reason is different in kind, not just degree. The global financial architecture is not stable, and the instability is not the kind that resolves over a quarter or a fiscal year. Consider what has happened in the months leading to March of 2026. The Strait of Hormuz, through which 20% of the world's oil supply transits, has been mined by Iran. American carriers have repositioned away from missile range. Oil prices are oscillating between $80 and $93 per barrel in a single week. Russia is sharing drone warfare tactical knowledge with Iran. China's satellites are providing real-time targeting data to Iranian missile batteries. The dollar-denominated global order, the system in which American military power guarantees free movement of commerce through international waterways in exchange for global dollar adoption, is showing stress fractures that are visible in real time. Here is the connection that most analysis of this geopolitical situation misses. The dollar's status as the global reserve currency is not a natural phenomenon. It is maintained by a specific arrangement. The United States guarantees the security of international shipping lanes, and in exchange, global commodity trade is denominated in dollars, recycling petrodollar revenues into American treasury markets and sustaining demand for dollar assets. When Iran mines the Strait of Hormuz and the United States cannot immediately and decisively reopen it, the guarantee is called into question. When American carriers reposition away from missile range, the military backstop that underlies the entire dollar system is revealed to have limits. Arthur Hayes, the founder of BitMEX, has made the most aggressive version of this argument, projecting Bitcoin at $500,000 to $750,000 before the end of 2026 in a scenario where global liquidity expands dramatically in response to geopolitical stress. That number is an outlier, but the mechanism Hayes is describing is not outlier thinking. It is the same mechanism that drove Bitcoin from $3,000 to $60,000 between 2018 and 2021, when quantitative easing expanded global liquidity by trillions of dollars. Standard Chartered revised their Bitcoin target down from $150,000 to $100,000 for 2026. That revision was not a rejection of the thesis. It was a recalibration of the timeline. They still see $100,000 as the base case. They simply moved the expected arrival date from mid-year to year-end. Bitcoin does not require the Strait of Hormuz to be open. Bitcoin does not require American carriers to be in position. Bitcoin does not require Chinese cooperation or Iranian compliance or Russian restraint or any of the diplomatic variables that every other asset class depends on for its underlying value proposition to remain intact. Bitcoin requires electricity and mathematics. Both remain available regardless of what happens in any particular geographical or geopolitical situation. That independence is not a feature that matters much when the existing order is functioning smoothly. It is a feature that matters enormously when the existing order is showing the kind of stress visible in March of 2026. Geopolitical stress does not produce smooth, gradual reallocation from dollar assets to alternative stores of value. It produces sudden, discontinuous movements when enough capital simultaneously reaches the same conclusion about where safety lies. The 5 forces, ETF inflows, macro liquidity, halving supply dynamics, regulatory clarity, and geopolitical dollar stress, are not independent variables. They are interacting in a configuration that has no historical precedent. ETF infrastructure means that when the geopolitical trigger arrives, institutional capital can move into Bitcoin within hours rather than months. Regulatory clarity means the compliance barriers that previously prevented institutional response to geopolitical stress have been substantially reduced. Supply dynamics mean the Bitcoin available to absorb that institutional response is at multi-year lows. The question is not whether these forces are real. They are documented, sourced, and analytically defensible. The question is whether they produce their maximum effect within the calendar year of 2026. This section is going to be different from the how to prepare content that appears in most crypto videos, which tends to consist of 3 pieces of advice: buy Bitcoin, hold Bitcoin, do not panic, delivered with the intellectual depth of a fortune cookie. The data we have examined supports a more specific framework. The first component is position sizing calibrated to your actual risk tolerance, not your imagined risk tolerance. Most people who think they have high risk tolerance discover their actual risk tolerance the first time they watch 40% of their portfolio disappear in 8 weeks. Bitcoin went from $97,000 to $69,000 between January and March of 2026. That is a 29% drawdown in 8 weeks. If you had allocated 20% of your portfolio to Bitcoin, you lost nearly 6% of your total net worth in 2 months. The analytically sound allocation range for most investors is 1 to 5% of total portfolio, with the higher end reserved for investors with both genuine risk tolerance and long time horizons. The second component is dollar cost averaging time to ETF flow data rather than arbitrary calendar intervals. Standard DCA, buying a fixed amount every month regardless of conditions, is better than trying to time the market. But ETF flow data, now publicly available, provides a more sophisticated signal. When weekly ETF inflows are strongly positive, as they were in the week ending March 10th, when net inflows hit $568 million, institutional demand is accelerating and the supply squeeze is intensifying. When ETF flows turn negative, institutional sentiment is shifting. Monitoring weekly ETF flow data from CoinDesk and TradingView takes approximately 15 minutes per week and provides a meaningfully better signal for accumulation timing than a calendar. The third component is exchange reserve monitoring as a supply signal. When exchange reserves start rising, meaning more Bitcoin is being moved onto platforms, typically in anticipation of selling, that is an early warning that supply dynamics are shifting. This data is available free from Glassnode and CryptoQuant. It is a leading indicator rather than a lagging one, and it costs nothing to monitor. The fourth component is a defined exit framework established before you need it. The most common failure mode in Bitcoin investing is not buying too late. It is selling too early in a panic or holding too long at a peak because the number going up feels like it will continue indefinitely. If Bitcoin approaches $100,000, what is your plan? At what price do you take partial profits? What percentage do you sell and what percentage do you hold? These decisions must be made now in writing when you're calm. They cannot be made well when price is moving rapidly and emotion is driving cognition. The fifth component is scenario planning for the downside case, because intellectual honesty requires acknowledging that 40 to 50% probability means 50 to 60% probability that Bitcoin does not cross $100,000 before the end of 2026. Standard Chartered has warned that Bitcoin could revisit $50,000 to $60,000 before its next major leg higher. That scenario, a further 20 to 30% decline from current levels, would represent an excellent accumulation opportunity for investors with the capacity to add at lower prices. It would represent a devastating loss for investors who allocated more than they could afford to lose. The difference between those two outcomes is determined entirely by position sizing decisions made before the drawdown occurs, not during it. Here is what the data actually shows, stated without hedging. Bitcoin is trading at approximately $69,000 in March of 2026, having corrected 29% from a cycle high of $97,000. That is the shallowest correction from cycle highs in Bitcoin's history. In previous cycles, comparable corrections ran 50 to 80%. The compression of that drawdown is itself evidence that institutional capital is providing a demand floor that did not exist before. 5 structural forces are simultaneously aligned in a configuration that makes $100,000 analytically defensible before the end of 2026. Spot. Bitcoin ETFs have accumulated lifetime net inflows exceeding $55 billion, with weekly flows remaining strongly positive. JP Morgan describes $100,000 as a realistic base case if inflows persist. The macro environment combines expanding global M2, a Federal Reserve easing cycle, and structurally inflationary American fiscal policy. The most favorable macro backdrop Bitcoin has ever operated within. The April 2024 halving supply shock is 11 months old, with historical peak appreciation occurring at 12 to 18 months post-halving. The halving effect is not done. Regulatory clarity has begun unlocking allocation from pools of capital managing tens of trillions of dollars, with even a 1% allocation representing $400 billion of new demand against a $1.4 trillion market. The geopolitical architecture of the dollar-denominated global order is under visible, documented stress, and Bitcoin is the only major asset class whose value proposition is entirely independent of that architecture's continued functioning. Prediction markets price the probability of Bitcoin crossing $100,000 before January 2027 at 40 to 50%. That is not a long shot. That is a coin flip weighted slightly toward yes, with 5 structural tailwinds providing the weight. $100,000 is not guaranteed. Nothing in financial markets is guaranteed. The downside scenario is real and should be planned for. But the 5 forces examined in this video are real, documented, and simultaneously present in a configuration without historical precedent. The people who were wrong about $16,000 were wrong because they were looking at price and sentiment while structural forces were accumulating beneath the surface. The forces are structural now. Pay attention to the structure, not the price.